Alright, so we are going to look at how the price of stock is set. And this is one of those concepts that baffled the hell out of me when I was just learning um, about stock market investing. And it baffles a lot of people out there who are learning about stock market investing. A lot of people, including myself, when I was first learning about stock market investing, thought that the corporations set the price for stock, or it was a person that set the price for different stock that was sold on the stock exchange. And that was absolutely wrong. Um, a lot of people think that the CEOs of these different companies, the top executives, have they set the price for the stock that's sold on the stock market, and they're manipulating the stock. They have a indirect effect to the stock price, but they don't have a direct effect on the stock price. All right, so we talked about the stock market, and the stock market is a place where buyers and sellers meet. We talked about this earlier. And in any market or store, there are prices for each product being bought or sold. And the buyers and sellers of these products have a say in the price. And in that, the price is set by the seller's willingness to sell and at what price, which makes up the supply, and the buyer's willingness to buy and at what price, which makes up the demand. Eventually, the price that the seller is willing to sell at will equal the price that the buyer is willing to buy at. And this price is what we would call the market price, or um, a lot of the technological term, or the techie term, is the equilibrium price. So the market price is constantly fluctuating due to supply and demand. This will constantly be changing. This phenomenon happens in your everyday life. You go into drugstores, you go into grocery stores, and you see that prices are constantly changing. The changes in these prices are based on supply and demand. If there, if a I worked in retail, so there were situations where we may have had a lot of inventory in the back room, or a lot of inventory of one particular product that we needed to get rid of. We had a lot of it, a lot of supply of it, and we had little buyers for it. It wasn't selling. So we had to reduce the price or discount the price in order for people to buy that product, to get it moving, to get it out of the stores. This happens, supply and demand happens all day, every day. It's a part of your life. And it's no different from being in the stock market. Supply and demand is real in terms of stock prices. Okay, stock sellers represent the supply, and stock buyers represent the demand. If there are a lot of sellers out there and little buyers, then the price of stock will go down. And these are not necessarily referring to the stock market in general. It's referring to the reactions to individual stocks or individual companies. So if there are a lot of sellers out there and little buyers, then the stock price will go down. If there are a lot of buyers out there and a few sellers, then the stock price will rise. And let's look at a couple of examples of supply and demand. Too many sellers, little to no buyers. One of the best examples that I can give is the Enron Corporation. The Enron Corporation back in 2001, 2002 was exposed for their fraudulent business practices, and eventually they had to file Chapter 11 and liquidate the entire business. Hence, putting them out. They were out of business. They could no longer operate. Holders of their stock, they tried to sell off their shares before all of this happened. However, there were no buyers out there. At that point, the news and the press was all over this particular story, and nobody wanted to touch Enron stock, and the price plummeted, and eventually it was worthless, completely worthless. I tried to buy Enron stock when this debacle happened. I made a mistake. What I was trying to do is that I was reading a story. I was reading the newspaper, and I saw that there was a company out there that was going to buy Enron stock. They were going to buy the corporation out, and take it over and try to reorganize it and bring it back. And that deal fell through. So my stock that I held in Enron was eventually worthless, and it wasn't even showing up in my portfolio. When you guys start trading, when you guys start investing in stock, what you're going to see in your account, or your trading account, that you have, you're going to see a list of all of the shares, or all of the companies that you own shares in. And Enron at one point in time was listed in my portfolio. Now at this present day, it is not listed. It's completely worthless. In this example, we're going to talk about too many buyers and little to no sellers. Apple Computer shares were once trading at $14 per share. However, with the recent success of Apple's iPod and the iPad, and they have a lot of products out there on the market, the MacBook, the share price has skyrocketed to over 100. Actually, it's over $200 at this point in time, and the rise in its price is due to a high demand of this stock, and the people who hold the stock don't want to sell it because it's a good company.